Okay, good morning, everyone. Welcome to the investment committee meeting for March 1st, 2022. On the call is Graham Stanley, Mark Potter, Doug Anderson, and Dmitro Yemskovich. Welcome to everyone from Vancouver and across the country. As always, the ICM meeting is a discussion of the economic, political, and market trends impacting our portfolios and trading decisions. Today, we're focusing on key themes of the Russia-Ukraine conflict and the impact on commodity prices, the impact on the inflation trends, and an update on the Canadian bank earnings. Let's get to work. Here's a picture of Kiev and the statue of the Monument of Independence in the city of Kiev, or Kyiv. Certainly, all our thoughts right now are with Ukraine, both from a humanitarian perspective and from a market perspective. It's the news that's dominating every aspect of the financial markets right now, from foreign currency, foreign exchange, commodities, and directly on the stock markets. I'll let you review this map on your own, but it's just highlights the key areas that are currently in Russia control and the areas that are most active in terms of the military conflict. Certainly around the large cities of Kyiv and Kharkiv. Kharkiv is a city of 1.5 million people, and Kyiv, a city of 3 million people. I should mention that the high-level talks between Ukrainian officials and Russian officials ended yesterday without a ceasefire. They said that they would continue meeting on Wednesday. I'm not sure if that's going to go on. In the meantime, the battles in the key cities are continuing and gaining strength as this day progresses. Russia is now warning of major attacks on key facilities. We've seen some really intense, shocking missile strikes in the city on key areas. While at the same point, the financial markets are trying to comprehend all the implications. And even while that's going on, Ukraine, with its current debt outstanding, had to pay about $300 million of bond interest payments today. And they've had to issue war bonds, raising $270 million to help pay for that. Anyways, big implications on this country. The markets were down this morning, but then they took a large leg lower on this news. NATO has announced that they're having an extraordinary meeting on Friday of the ministers of foreign affairs from all the NATO countries. This is occurring on Friday. They're calling it an extraordinary meeting. We'll see what comes from that. But as the war continues to escalate, as these big cities are being cut off from their natural supply chains, and the longer this goes on, this could become a humanitarian crisis for the citizens who live there. We'll see what NATO's response is. As always, the concern up to this point has been NATO and U.S. involvement in Ukraine directly would then put NATO and the U.S. in direct conflict with Russia, nuclear powers. It's sometimes we can take a pause and just reflect on Canada's connection to Ukraine. Canada, in fact, has a close connection to the country. Outside of Russia, Canada is home to the most people of Ukrainian heritage in the world, 1.3 million, according to the 2016 census. Most of the Ukrainian ancestors came to Canada after the World Wars and the collapse of the Soviet Union. And interestingly, Vancouver has a sister city, Odessa, Ukraine. There's a special connection between these two cities. And in recent days, Vancouver City Hall has been lit up in Ukraine's blue and yellow. Now, when we look at the impact on commodity prices, we first look at the impact on natural gas and oil. And so Nord Stream 2, Germany has canceled the certification process of Nord Stream 2. They did that last week. In fact, today, the company that is running Nord Stream 2 officially filed for bankruptcy and has laid off all their workers. A threat from the former president of Russia, Medvedev, last week was that, well, if you're going to shut off Nord Stream 2, Europeans can be expecting to pay significantly more in terms of natural gas. This is just a threat, but we can see here that if this threat came true, that would take natural gas pricing to where it was, at previous peaks. Big implications. Now, Russia is a major exporter of natural gas and oil to Europe. You can see here that natural gas Russia accounts for 45%, roughly, of all natural gas exported to the European Union. So when we look at the impact on the energy markets, it is severe. And the impacts, we're just in the early days of this and the impact on Europe. But interestingly, and I wasn't really quite aware of this, but even the US has been an importer of Russian oil and petroleum products over the years. This is just a chart showing the imports from Russia into the US. You have to think that this needs to stop. And hopefully it would be strong to see some leadership in Canada and the US with regards to energy production. Hopefully we can move back towards some measure of energy security in both countries. And certainly if the US increased production and was able to meet the shortages in Europe, that would be strong for the Allies. We may get more news out of this, likely against this idea from the State of the Union this evening in the US, where they're expected to focus more on climate change than on oil production. In terms of commodity prices, we're seeing big spikes across the commodity spectrum. And this is another reason why. Ukraine is referred to as the breadbasket of Europe. Ukraine and Russia they're vital to the global food supply. You can see here that they account for more than a quarter, the two countries, of global wheat and about 1/5 of corn. It's about 12% of all the calories traded globally is from Russia and Ukraine. Another impact of this is that they've closed Ukrainian ports during this crisis. I mean, things are really tightening up here. Since the war, this is a chart here of the Bloomberg Agriculture Subindex, and you can see that the prices following the worst of the pandemic, when everything was trading at low levels, we've already seen inflationary impacts as prices have moved higher with the reopening of economies. Now the war started, and over the past week, WTI was up 8% up until yesterday. Brent was up 6%, corn up 7%, and soybean up 8%. Wheat up 11 to 15%. Today, WTI is up a further 9% as the war continues to escalate. Now, there's been a lot of talk about the impact on foreign exchange, in particular basically the destruction of the Russian ruble. We're seeing movement in both gold and cryptocurrency. And although interestingly, up until yesterday, while gold was up just over 1% since the war began, Bitcoin's up almost 20%. And then today, gold's up another 2.3% and Bitcoin up a further 5%. Big moves. You might think that as some investors, some people are seeking to find a currency safe haven while SWIFT is being shut down in Russia, even though on a limited basis it's being shut down. crypto has been moving higher. Now, interestingly, and we spoke about this a few weeks ago, coming into the end of January, how the market was almost pricing in a crash in the markets with record amounts of puts being bought on the indices. And so the implication of that is that while the market is kind of hedged for a crash, there can also be periods of high volatility because and we've seen this over the past week now, there's been periods where the markets have caught a bid and have moved higher swiftly, and then the moves become really high to the upside. And that's part maybe a bit of relief from news flow, and also short squeezes with the defensive posturing that some market participants have. So this is this can be a very active environment for our heavy trading clients. For our managed portfolios, we've already taken a defensive position with our portfolios. It's probably best to maintain a steady hand, understanding that it's a pretty active time for our active traders. Now, all this activity is having a big impact on the yield markets and the expectations for interest rate hikes. We could certainly see the case that the geopolitical tensions may give the Fed some cover and give them the opportunity to proceed cautiously on tightening. And there may be less political pressure to combat inflation amid the conflict in Ukraine. So interestingly, there's now less than a 2% chance of an outsized 50 basis point hike in March when they meet on March 16th. This was previously a 90% expectation after the hot CPI number in January. So we're expecting a rate hike in this month in March, but only 25 basis points now. So we'll see. Some economists are noting that the near-term effects of the crisis appear to be inflationary. Certainly, we see this in commodities, although the impact may be somewhat offset by a hit to growth. So I'll let you look at the chart afterwards, but we're seeing here that the rate hike odds are decreasing. This is in gold here is the one for March. So we're seeing just the odds of one rate hike, meaning 25 basis points. And if we look out to by December, that's blue right here. That's where they were factoring in, 6.5 rate hikes by the end of the year. Now that's at about 5 rate hikes, and we'll see how that develops. We've noted this previously. At the beginning of the Olympics, there was a high-profile meeting between President Putin, Russia, and Xi in China. This appears to be a relationship that's growing with Russia, an appetite for power, and China, an appetite for commodities. The current focus is on Ukraine, but we may need to look ahead to China, Taiwan at some point in the future. Graham, you and I talked about this. We talked about the important work done by Morgan Stanley over the weekend, encouraging all of us to use critical thinking in how we're observing the current situation. This goes back to the Johari window, the discussion about knowns and unknowns, and just to talk through this table here, the known knowns, I mean, it's changing, but the known knowns by the market is regarding inflation and the expectations for the Fed, and that's known by us, in this case Morgan Stanley, and known by the market. Definitely an unknown is the Russian invasion and what the outcome is going to be and all the implications. We're working through it as best we can, but there's with each change of news flow, big implications that have yet to be determined. And honestly, the economic impacts of all this are going to be years in the making. Morgan Stanley's come out and they have a view on earnings. They view that growth is decelerating. Now, they view this as their competitive advantage, something Morgan Stanley knows, but others don't. That's a known unknown. And so, Morgan Stanley is viewed as a kind of a bear in the market. Their expectations are lower for the markets relative to others. But it's important to hear their perspective, and we can talk about that further and look at their earnings expectations over the coming quarters. But it's interesting here from Morgan Stanley's perspective, and we can look at this in other decisions we have to make about the unknown knowns. And so what they're saying here is that the market is expecting earnings to be strong in coming quarters, and Morgan Stanley doesn't know that. That's an unknown known. They could be strong or they may not be. This is viewed as a blind spot, the unknown knowns. And so it's always important when we're looking at our decision-making process to be aware of any blind spots we have as well, and we can talk about this further. But interestingly, of the unknown knowns, they're pointing to the ratio of negative to positive guidance has spiked, which is a leading indicator for earnings revisions. So even though guidance for the coming quarters is reasonable, is good, we're starting to see that some of this guidance is changing and is about to be revised. So this might be a negative for many companies. They also gave some observations on the S&P that we can just talk through. Certainly, we saw a lot of volatility in the markets last week when the Ukraine invasion first happened. That was a big blow to the market, and we can see this here, the S&P kind of retesting its January lows, and then we had a strong reversal of that, and we closed the week strong on the S&P and in the broad markets. So this is bullish in the short term, although it doesn't look very good in the intermediate term. And then if we step back a bit, their concern is that okay, so short-term retesting of the January lows, that was successful. It may, today notwithstanding, set the market up for a movement forward. If things continue to be rough with the geopolitical events and uncertainties regarding Treasury and so forth, then you look towards the longer term 200-week moving average as a kind of baseline level of support for the market. And with the extended markets that we've had over the past couple of years, from low interest rates and all the stimulus that allowed the markets to hit the high levels, we're still trading with lots of air, lots of room, well above the 200-week moving average if things got really rough. So let's keep an eye on this. It's, in the short term, we can see support for the markets. In the intermediate term, we'll have to have a call on the market in terms of how rough things are getting, and if we need to become even more defensive. At this time, we have elevated cash positions, especially in our U.S. portfolios, up over 20%. We have a lot of insulation there, but let's just be aware, that the 200-week moving average is still quite a bit lower. I think their reference point here was that back in 2018, when the markets had a big correction, it only found support when it hit the 200-week moving average. Just to focus on more local issues, our Canadian banks are right in the midst now of earnings season. We've had Royal Bank and CIBC last week, Bank of Nova Scotia, Bank of Montreal today, and TD Bank coming out in 2 days on March 3rd. What we've seen so far is this quarter has been strong. Strong loan growth backed by residential and commercial loans. Canadian housing sales continue to be solid, and business investment continues to increase. Your earnings have been good. Our earnings per share, you can see this here. So far, each one's been a beat. Strong earnings, really strong performers. Our Canadian banks are in good shape. The guidance looking forward, still very positive. Notwithstanding a challenging global environment. This is important here. So a lot of focus on the 10-year Treasury bond yield. Here we are talking about the Canadian banks. We've seen a drop in the U.S. 10-year this afternoon, closing at 1.72%. Just last week and over the past couple of weeks, it was trading at right near 2%, even over 2%. So we've had a big drop in the U.S. 10-year. This is reflecting the changing expectations regarding interest rate hikes, and certainly looking forward and likely starting to factor in maybe a recessionary environment out perhaps in 2023. The lower bond yields, we've been talking about the rising bond yields as having an impact, a negative impact against long duration tech stocks, but this was also a benefit to financial stocks as their margins tend to increase during periods of higher bond yields, higher rates. This drop in bond yields kind of had a negative impact on part of the financial stocks today, especially in the US, and both their banking stocks and their insurance stocks. So we'll see how this plays out. That'll probably moderate as the market starts to calm down. But in the meantime, certainly the lower bond yields are having an impact on the sentiment short-term on financial stocks, especially in the US. Just some notes here. I'll let you read this after the call. There's been a lot of talk in recent days about SWIFT. We were expecting that the US and NATO and other countries would impose heavy sanctions on Russia, SWIFT being the so-called nuclear option to that. SWIFT, just by name, is the Society for Worldwide Interbank Financial Telecommunication. It's the global financial system that allows immediate and secure transfers of money across borders. It links 11,000 banks and institutions in more than 200 countries. It's a dominant way that financial transactions happen around the world. And to sanction Russia, they're basically shutting Russia out, with some exceptions. They're excluding payments for oil and gas and some other commodities, but they're largely shutting out Russia from the global financial system. We're not quite sure what the implications of this will be long term, not just for Russia, but for other countries as well. Certainly, there's many Middle East countries that trade with Russia quite closely. We're not quite sure what the impact will be for those countries. And China has a parallel system called the CIPS, the Cross-Border Interbank Payment System. This facilitates transactions in Chinese yuan. Again, we're not sure what the implications of this long-term will be, but you can certainly anticipate that more Russian transactions will start to be done on the CIPS, seeing as they can use the SWIFT program. Anyways, we'll have to be aware of this over time as the geopolitical events are going to kind of change the borders for how financial transactions happen for many countries. Interestingly, only 3 countries in the world are banned from SWIFT: Iran, North Korea, and now Russia. And we're not talking about COVID very much these days, but I thought I'd just put this on our radar. Now, Hong Kong seems to be kind of a unique territory when it comes to COVID. It's a very dense population in a very small region. And this caught my attention yesterday as Hong Kong recorded a daily high record of near 35,000 new coronavirus cases from this Omicron variant called BA2. And, just in the South China Morning Post, talking about how they've hit record numbers of COVID fatalities, hospitals are being overrun, mortuaries are being overrun. I'm not sure what this means beyond Hong Kong in the coming weeks, but I'm just putting it out there for us to be aware of. anyways, there's a lot going on. We'll talk about our portfolios directly following the meeting, and the market implications of current trading. But just wanted to talk through some of the current issues that we're seeing here in the market. Thanks, everyone. Thanks for joining us today.